All right, welcome to This Explainer. Today we're doing something a little different. We're completely bypassing the usual startup hype because we're looking at a source deck built specifically for investment committees, wealth managers, and family offices. So if you're just looking for big promises, honestly, this one might not be for you. But if you want to see pure institutional methodology at work, evaluating an opportunity strictly on logic, deal structure, risk mitigation, and execution, well, you are absolutely in the right place.
Let's kick things off with the core philosophy driving this whole deck. The success of a major venture doesn't just depend on, how much money you can throw at it. It actually depends on how that capital is structured and how incredibly resilient the underlying business model is. We're looking at a project today that fundamentally gets this.
So before we even look at the project itself, let's establish why this even warrants institutional attention. It comes down to these core pillars. We're talking about a massive global real estate sector, approached through a highly diversified model, with disciplined risk management sitting right at the absolute center of it all. Plus, measured international expansion and strategic partnerships.
Okay, so what is it? First, go ahead and discard the idea of a simple real estate agency or your basic service startup. The Holo Real Estate Club is proposing a massive, comprehensive international ecosystem. It seamlessly combines tiered memberships, over 20 specialized digital services, and a really robust media and broadcasting arm. It's the whole package.
Now, this completely shifts the conversation from what the project does to how it actually protects your capital. The absolute bedrock of this ecosystem is revenue diversification. Look, for an institutional investor, a single point of failure is a total non-starter, right? By interlocking multiple revenue streams, this model inherently reduces its reliance on any one specific sector of the real estate market.
So instead of relying on just a single market, the model basically builds a protective web. Your revenue comes from a massive base of subscription memberships, and then you layer on specialized professional services. Think legal, valuation, property management. Then you add in real estate auctions, highly lucrative TV sponsorships, and 12 annual international exhibitions. You see how these streams interlock? If one market softens up a bit, the others are right there to absorb the impact.
Which brings us to arguably the most important part of this deck. Because, let's be real, you absolutely cannot talk about billions in targeted revenue without first proving you can survive a worst-case scenario. Every successful investment starts with risk management before you even think about calculating profits. And that is exactly how the source material models its financials.
The deck provides a few different financial scenarios. But looking at this through an institutional lens, we need to deliberately ignore the upside for a second. We have to anchor our evaluation on the highly conservative baseline scenario. We need to know exactly what happens if things just don't go according to plan.
And this number right here is absolutely vital. The financial model actually proves that even if the project achieves only, say, 10 to 15% of its target metrics in year one, the generated revenue still hits between $310 and $465 million. So even under strictly conservative, stress-tested assumptions, the model easily covers the required operating capital and stays profitable. The downside is heavily, heavily protected.
Okay, so with the baseline secured, now the target scenario comes into focus. This $3.1 billion figure, that's built on securing 1.5 million global members, 500 corporate TV sponsorships, and running those 12 international exhibitions. Yes, it's a very ambitious upside, but it is an upside built entirely on the foundation of a heavily risk-adjusted operational model.
Phase 1. Strategic deal structure and tranche-based de-risking.
Now, as we all know, a fantastic business model can still be totally ruined by a chaotic open funding round. So instead, this is a strictly closed alliance. The round is set at exactly $150 million, and it's divided equally among just 5 strategic partners. Each partner injects $30 million in exchange for 5% equity, meaning exactly 25% of the company is allocated to this specific, highly strategic group.
And here is where the institutional governance really shines. That $150 million? It is not handed over in a massive lump sum on day one. No way. It is milestone-driven. $50 million at closing for initial setup. $50 million at 90 days once testing and first markets are live. And the final $50 million at 180 days for the full 15-country rollout. This ties the capital directly to actual execution phases, ensuring high capital efficiency and adding just another fantastic layer of risk management.
Now you might be wondering at this point, why make the structure so incredibly rigid? Why limit it to exactly 5 strategic partners instead of just taking capital from, well, Whoever is willing to write a check.
Well, because this isn't just about money, it is all about leverage. Selecting 5 investors from 5 distinct key markets, like Saudi Arabia, the UAE, Qatar, Egypt, or the UK, allows the platform to basically instantly open borders. These partners bring localized institutional relationships and critical regulatory access. They aren't just funders, they are catalysts for international expansion, acting as a direct bridge into their respective regions.
Phase 2, market readiness, moving from concept to execution.
Look, a brilliant model on paper is pretty much useless if it can't be built in the real world. But the team here has aggressively moved way past the idea phase. The digital platform and app, they're already in advanced stages of operational testing. And the initial promotional outreach has already yielded really strong market validation, with major corporate entities locked in and ready to onboard the exact second the platform goes live.
And their endgame isn't about trying to just conquer the world on day one, it's a highly measured rollout. By specifically targeting 15 key countries in year 1, they establish a firm operational base. That provides a really clear, scalable framework to then expand to 100 countries over a 5-year period. It is infinite scalability for sure, but executed with serious discipline.
So, to summarize this whole institutional thesis, why exactly does this model work so well for a wealth manager or a family office? Because it targets a massive sector but applies a highly disciplined, downside-protected framework. It brings together a global media ecosystem with standard professional services. And most importantly, the milestone-driven governance of the deal itself actively protects the capital every step of the way.
I want to leave you with this final thought from the deck. Audacity and big ideas, those are common, but turning ambition into reality requires a clear vision paired with a diversified model, disciplined risk management, and the right strategic alliances. Hololo Real Estate Club has built the precise framework to do exactly that.
If you are part of an investment committee, a wealth management firm, or a family office looking to participate in building a truly long-term global ecosystem, this structured opportunity is definitely worth your deeper analysis. I highly encourage you to reach out directly to the Holo team to initiate those discussions. Because as the real estate sector gets more and more complex, the question really isn't just where you deploy your capital, it's whether the ecosystem you're investing in is actually built to withstand the future. Thanks so much for joining me for this explainer.